everyone, welcome to New Order YouTube channel. I'm Amber, I'm the venture manager at New Order. Good to see you again. So far, we have incubated 23 projects, including Redacted, H2O, Frogs Anonymous, and Y2K Finance, the founder of which is here with us today. Today, we're going to talk about initial farming offering, IFO. You might already heard of other liquidity events like ICO, IDO, IEO. So what's the difference between all of them? And why did Y2K decide to use IFO to bootstrap its liquidity? What are some key learnings? So you're going to find answers in this video. If you are a founder building a DeFi protocol, or you're thinking about launching a token for your own product, then you cannot miss it. Before we get started, Che and Crypwalk, would you like to introduce yourself?
Yeah, absolutely. My name is Crypwalk. I'm one of the founders here at Y2K. Was an ex-employee at New Order, an ex-research analyst there. And yeah, I'm happy to be here today.
Welcome.
Yeah, and I'm Che. I lead growth at New Order and was helping out a bunch with the Y2K launch. So also happy to be here.
Happy to have you. So for those who don't know, what is Y2K Finance?
Yeah, so I'll take this one. So Y2K Finance is a suite of structured products designed for exotic peg derivatives that allows market participants to the ability to robustly hedge or speculate on a risk of particular pegged assets or basket of pegged assets deviating from their fair implied market value. And our initial product offering is Earthquake, which is essentially a two-sided vault and offers binary options on stable coins and other pegged assets depegging.
Thank you. So as a user, if I hold stable coins in my portfolio and I'm worried about depegging risk, so I can go to Y2K and supply capital in its hedge vault. So that will act like my insurance policy, correct?
Exactly. Yeah. So yeah, if you have a position in stable coins and other pegged assets that will be introduced to the platform, you can go ahead and deposit a premium on the hedge vault during or weekly or monthly epochs to take out some coverage against that position. And conversely, if you are a believer in one of these stablecoin or pegged assets and you're willing to underwrite the risk of these certain assets depegging, you can deposit on the risk side of the vault some collateral, which would be liquidated over to hedge depositors in case of a depegging event. But if that weren't to happen, you would collect a premium for the other side for your willingness to underwrite that risk. You would collect that premium whether depeg event happens or not.
Sounds great. So if you're interested to learn more about how those vaults work, how long's the epoch, how the strike price is determined, we previously recorded another video with Crypwalk and Dre. So you're welcome to take a look. I'll link it in the description below. So, okay, let's go back to the main topic of IFO. So what exactly is initial farming offering and how does it differ from, let's say, ICO and IDO?
Yeah, so an IFO is essentially another means of bootstrapping the protocol native token, or essentially launching a protocol in general. And IDOs were, I'd say, had a large amount of dominance in the previous, I'd say, year. And then before that, and, kind of looking at 2017, ICOs were like the dominant method of launching. In the end of the day, between an ICO and an IDO, there isn't, like, let's say, that big of a difference. It's just the mechanics of the price changing with bits. For example, an IDO is a Dutch auction. It could be a reverse Dutch auction, could be a regular Dutch auction with various mechanics implemented on top of it. Like, for example, the effect of the price movement based of the bid that came in, or the length, or the minimum price, or the maximum price starting in the particular Dutch auction. From the perspective of an IFO, is, I would say, a flip from simply bootstrapping the token and effectively selling the token. You're incentivizing usage of the protocol, right? So, and that does have a large benefit to the protocol, considering it has PMF, and there's users who are interested in trying out the various mechanics that the protocol is offering. And it also provides this layer of initial incentivization for users to play around while they are kind of starting off. They want to be incentivized, they want to have a level of compensation for the initial kind of first stages. which I think makes a lot of sense, where users are actually utilizing the protocol and the holders of the token are indeed the users at the same time, and you're not splitting these two stakeholders into two distinct groups, and you're actually ensuring that the users of the protocol and the holders of the token are indeed the same stakeholder. And that creates like a much easier environment for you as a founder, as a builder, to align those incentives and ensure that the token holders who are indeed the users are synergetically existing on the platform per se. There's several considerations to take in whenever somebody's structuring a platform, a offering like that. It really depends on the mechanics. It really depends on the revenue generation of the protocol itself, whether it makes sense to bootstrap and emit such a large token supply in the beginning or not, right? But I think we'll be diving in a little bit deeper into this topic further down the conversation.
Yeah. So let me see if I can get this right. So for any given token projects, there are two types of liquidity. The first one we're familiar with is the trading liquidity, which is to make the markets available for buying and selling tokens. It's very similar to what we do in the secondary market if we want to buy and sell, let's say, Tesla stocks. But holding a Tesla stock does not mean that you're using Tesla products. So there's a disconnect between the trading liquidity and the product liquidity. So the main advantage of IFO is that incentivize liquidity providers to actually use the product itself. And it's the rewards, it's based on its usage. The more the usage, the higher the rewards. Is that correct?
Yeah, exactly. As I was mentioning, it's kind of that stakeholder problem, right? Where you want to ensure that you're allocating the largest amount of resources efficiently towards actual protocol usage. And then IFO essentially does that, right? Like it unites the two groups of stakeholders, the token holders and the users, into one group, as you were mentioning with that Tesla example.
Yeah, great. So next question, tell us more about the result of this IFO in terms of how much TVL enabled, how much protocol revenue, etc.
Yeah, absolutely. So yeah, during the IFO, the highest amount of TVL we were able to get into the vaults was about $12 million across all vaults. And we were able to average around $7 to $12 million during the whole IFO. In terms of revenue, the generation, we were able to rate because of a couple of depegging events that happened with USDT and MIM. We were able to generate a substantial amount of revenue, around 290 ETH, and that's from when the value of ETH, depending on the value of ETH, that was between $350,000 to $337,000, and half of that was just attributed to our VL Y2K lockers about a couple of weeks ago. So that was 145 ETH that was redistributed back to those who locked their token with the protocol.
Excellent. So let's go back to the design of IFO. What are some key considerations when you design this IFO program in terms of length, how much tokens to offer to the users?
As Che was mentioning, they're pretty protocol specific. And for our protocol, one consideration was based off of the kind of behavior we wanted to incentivize within the platform. How do we kind of split up the emissions between the hedge vaults and the risk vaults? So we decided to go with a 2-to-1 split there, where the hedge vaults will have double the amount of rewards emitted throughout the IFO than the risk vaults, because we thought the hedge vaults kind of where they created the yield for the platform, and like they created the flywheel of the ETH premium returns for those who deposit collateral. And then also kind of was the amount of tokens you want to try to distribute. And for us, we wanted to give 5% of our token supply out to the community. And we were able to do that over 2 months. And it was kind of between the amount that we wanted to distribute, how long we wanted to distribute that amount over, and then how we wanted to split that amount between the vaults.
And how, if someone were to design a IFO package from the beginning, then they will have to take consideration into the protocol revenue it generated from each stakeholders, and based on that, you distribute the token rewards.
Yeah, exactly. That's also a consideration as well. And that also goes into how you design your incentives during the IFO to kind of drive the behavior that you want the users to take on a platform, and like assuming you want those users to engage in behaviors that generate revenue, which is why we kind of doubled down on the hedge vaults, which we thought would generate more revenue for the platform.
That makes sense. Anything to add, Jay?
Yeah, I have a couple points. So as Crip was mentioning, right, like it's all about user incentivization of the platform itself. And since we're uniting both the token holders and the users into one stakeholder group, it does become a wider kind of range of let's say actions that the user can the protocol owners can partake in from the perspective of for example the fees that the platform offers, right? From one perspective, the fees are discouraging usage of the platform. From another perspective, considering the users of that platform are also token holders, you're increasing the revenue that they're receiving from partaking in locking the token itself. So you increase that margin of flexibility that you have whenever you're operating a protocol with a united kind of stakeholder mass. And that was the primary consideration that was in front of us when we were building out the program. And I think we were able to unite those groups, and honestly, it really helped us from the perspective of just orchestrating the proceedings and moving forward, where we know that these stakeholder groups are one in itself.
Excellent. So as you mentioned before, Crypwalk, a user can be on, because it functions like a binary option. So in theory, a user can be on both sides of the vault, can be on both hedge vault and risk vault, just to get Y2K rewards. So do you see that as problematic?
I think like it's not like a black and white. There kind of there's a balance because for all of these DeFi protocols who use their native token to incentivize kind of the users of their platform, there's always a degree of people who are just there to kind of farm the token, right, and kind of accrue more of the token over time. But I guess it's kind of the poison you have to drink as well, because they also provide liquidity that others can use who are truly trying to take out hedges or who are truly trying to collect premium, right? These people that are just trying to essentially delta neutral farm the vaults, if there's a good balance of them to create enough liquidity for people who just want to go on the one side on your side of the vault, I think then you have a happy medium. But that's always tricky, right? You're just kind of looking for almost like everything in life, just like a good balance of those users who are always going to be there, and then those users who are truly trying to use a protocol as was intended.
And even if a user be on both sides of the vault, they're still generating protocol revenue for Y2K as well. So it's a counteract.
Exactly.
I see. So I know that Y2K recently listed on Balancer. So I'm curious to learn what are some key considerations or deciding factors when to list.
Yeah. So for us, it was kind of down to our goal was to get 5% of our token out to distribute it to the community in a fair manner. And once we felt like we accomplished that or were close to that, we felt it was the right time to kind of launch a token and allow people to have access to the tokens that they've been kind of earning throughout the IFO events. So it was just really based off that main factor of having that number, reaching that goal of that threshold of 5% being distributed out to community. And then once that was done, then we're able to let the community have access to their tokens.
Anything to add here, Jay?
Yeah. I think one of the biggest considerations is also setting the price of the token, right? At the end of the day, it is quite arbitrary, right? As there is no previous price history, and it's very difficult to ensure like a smooth sailing into a token offering like that, right? So it is very important to just outline some of the expectations and ensure that the token isn't priced in a way that is I would say too high or in a borderline manner that promotes people to dispose of it, right? Where it actually prices it fairly from the perspective of some of the industry comparables, and that's probably the best way to go along it. And then another point is whenever you're seeding a balancer pool and you have a IFO that was previously running, you have to be very instrumental in when those tokens are able to be claimed and when you seed the actual pool. Those things need to be very closely considered to ensure that you're encouraging the right behavior, right? So from our perspective, we were launching the lock mechanics or VLY2K concurrently with the token itself. So that allowed people to have a multitude of actions that they could partake in whenever the token is actually live. Instead of just simply having an option of going straight to the balancer pool, right? Like there's an optionality that people can take and participate in the upside of the future of the protocol through locking it, right? So I think that's a very important point to where you're exactly directing people to do and what action items are you promoting.
Yeah, absolutely. So speaking of Y2K token, what is the utility of it? What does Y2K token enable you to do?
Yeah, so every user that has a Y2K token has governance power within our system, and that allows you to partake in kind of governance votes when they happen. And once we be introducing our gauges, it'll be you may be kind of in line to receive bribes as well, right? Like every Y2K token has voting power, but they have like 20% of voting power that the VL Y2K lockers. And once you are able to, if you were to lock your Y2K tokens, then you would have access to the protocol revenue, 50% of the protocol revenue. So if you were to lock for 16 weeks, you would be able to get 33% of that protocol revenue, and then of that 50%, right? And then 32-week lockers will be getting 66% of that. They'll be essentially be getting double of the fee revenue as a 16-week locker for locking for double the amount of time.
I see. So Y2K token enables revenue sharing with the protocol as well as the governance.
Exactly.
I see. Okay, last question. If someone wants to get in to learn more about Y2K, what's the best channel to do that?
Yeah, so our Twitter is where we have all of our updates when our vaults open, our vaults close. That's at Y2K Finance. And then you can also go to our Y2K Finance Discord. And then on Y2K.finance, you can also look at our Gitbook and our docs to learn more about how the protocol works. And we'll also be, just like you guys in New Order, kind of spinning up a YouTube channel shortly, a Y2K Finance YouTube channel that will have all sorts of explainers from how the different mechanisms of the assets that we carry on our platform work to how our tech stack works as well. So those will be all the mediums that you can learn more about our protocol from.
Excellent. This has been very informative. Thank you, Che and Crypwalk. Hopefully the audience feels the same. Thank you for listening. If you have any additional questions, please leave it in the comment section below. Make sure to follow us on our socials. I will also link that in the description, and join our Discord to stay updated with New Order ecosystem. Thank you.